Okay, good morning once again. Today we're going to be looking at capital allowance. In our previous class, we've looked at the concept of adjusted profits, where we actually add definition of uh, the accounting profit and the adjusted profits, where we said accounting profit is a profit that takes care of that uses the principle of International Financial Reporting Standard, that uses the principle of generally accepted accounting principle, and that uses international accounting standards in the derivation of the profit. Meanwhile, for the taxable profit, we had said that for taxable profits, it is the principle of tax laws or tax law was used in derivation of the adjusted profit. And therefore, one of the key things that we said in our last class was the fact that depreciation is not an allowable reduction because for an accountant believes so much that they should depreciate assets. And once they depreciate the assets, the value that they have depreciated it will be set aside to replace the assets in the future. So on a yearly basis, they will calculate the depreciation, and that depreciation will be used to reduce the profit. At the end of the day, they will now reinvest that amount in acquiring another asset because on a yearly basis, they've been setting aside that value. However, this is not the case for taxation because in taxation, they look at it in a different way. In tax, we have always said before you recognize expenditure, you must have incurred. Before any expenditure is recognized, cost must have been incurred. Therefore, we said depreciation is not out of pocket funds, so you have not incurred any expenses. In that regard, that would not be an liable deduction. So if depreciation is not a liable deduction, there are two principles in tax that helps us solve the problem of depreciation. That helps us solve the problem of depreciation. Number one is the capital allowance. Number one is capital allowance, while number two is capital gains tax. I'm very sure Mr. Idris must have started taking your capital gains tax by now. And you remember in your capital gains tax, you will say your tax is going to be charged on gains, capital gains. So in taxation, for example, we also said when you dispose an asset, that disposal is not going to be subject to tax. The profit on the disposal will not be subject to tax in company's income tax, rather in capital gains tax. So capital gains tax has its own issue of depreciation. Not only that, when you talk about um, capital allowance is more or less like a direct replacement for depreciation because we have said depreciation is not allowed. Now, why is it not allowed? I'll tell you. Depreciation lacks consistency because imagine two companies acquiring the same asset and they put them into production use at the same date, different amount of depreciation. Company, you cannot compare them in any way. Again, you know for sure that there is no accounting standard that says that the companies should be preparing the account using the same method of depreciation. I could decide to use straight line method, and I could decide to use reducing balance method. So there is no accounting policy that says company must use the same amount of the same method of depreciation. Having said this, it is instructive to note that, again, I can decide as a company accountant to adopt a depreciation method and depreciation rates. So my accounting rates might be different from your own accounting rates. So it brings a lot of disuniformity and inconsistency. And that was why capital allowance was introduced. Having said this, we all know that the introduction of capital allowance is very essential in our computation. So when you talk about capital allowance, for example, capital allowance is an allowance granted to a taxpayer that has incurred qualifying capital expenditure and put them into production use at the end of the business period. So I'll say that again. Capital allowance is the allowance granted to a taxpayer that has incurred qualifying capital expenditure. That is, a taxpayer that has incurred capital items is expected to be granted capital allowance. Now, one of the important things that you need to know is that capital allowance is a form of tax planning where the taxpayer would be allowed to take advantage of the loophole in the tax law. Capital allowance is an example of that, because when you talk about capital allowance, you can use it to reduce the profits that you're going to pay in a particular year. So we are saying that capital allowance is allowance granted to a taxpayer that has incurred qualifying capital expenditure and puts same, that is that asset, into production use at the end of the basis period. Now, my definition is very clear and straightforward. When you look at what I've said so far, I said is allowance granted to a taxpayer that has incurred qualifying capital expenditure. That means before a taxpayer can be granted capital allowance, such a taxpayer must have incurred what we call qualifying capital expenditure. Okay? By implication, also, we are saying we are granting you this allowance because you have incurred some certain expenditure. Okay? And we are also saying it is granted to a taxpayer at the end of the basis period because this taxpayer, the assets in question must be used all through the useful life of the assets. There is no element of temporary disuse in this regard. So you must continually use the assets so that you can claim capital allowance. Okay? A layman definition would have been that capital allowance is the allowance granted in lieu of depreciation charged in the income statement by the taxpayer or the individual. Okay? So we are saying that it's a direct replacement for depreciation. I haven't known that depreciation is a spread of the historical cost of the asset over its estimated useful life. Now, basically, we're going to be looking at three types of capital allowance. Number one, we are going to be looking at the initial allowance, what it means, the annual allowance, what it means, and the balancing allowance, what it means. Those are the types of capital allowance we have. So the definition has been given, and let's quickly look at the features of capital allowance. Now, when you talk about the features, it has a standardized rates. Everybody, all the taxpayer that has acquired the same assets and put them into production use will be charging the same amount of capital allowance, will be using the same rates if provided the asset is the same or falls under the category of the same class. Equal amount to be granted to the taxpayer, and for this purpose, the same set of rules are applicable to the taxpayer. The same set of rules are applicable to the taxpayer. The document has been shared in the WhatsApp group, except if you are not in the WhatsApp group. Oh, okay, it has not gone through. I'm sharing it. Sorry, guys.
Yes, it has dropped. Thank you.
Thank you, KG. You're welcome, KG. KG, is this your first time?
Yes, I usually join the other class.
Oh, okay. You have not joined our tax class, my class, before.
No, I haven't.
You're welcome. Thanks for coming. All right. Hope I'm audible enough, and hope we are getting what I'm saying. Ibrahim Okesede, you are welcome. Just joining us. I'm seeing you for the first time. Okay, me join last class. You're welcome again.
Yes, sir. Thank you.
Ibrahim, you're welcome.
Yes. Okay, thank you.
All right. Who else is joining? Mercy, where were you last week? You did not join the class last week.
I wasn't around. I wasn't available to join the class this week. Good morning.
Good morning once again.
Thank you.
Okay. All right, we can move ahead. This is Bukunle Olutade. This is your first time. Right?
No, it's not my first. Good morning.
Good morning, Ibukun. All right, let's go. Yeah, I remember your voice now. You read for us last week. Okay. So, as I was saying, I said the same set of rules are applicable to the taxpayer. Why? Because there is a standard that every taxpayer follows. Okay, unlike in your financial reporting, there is no standard like that. Everybody can decide to use different method. Nobody questions the method you use. But here, you must use, because there is a table, and we believe that everybody must apply themselves, must apply these rules to the letter. Now, the benefit of claiming capital allowance, just like I said the other time, it brings about immediate tax benefits, cash benefits, because it reduces your tax liability. It improves your cash flow, and you can invest back or plow back that amount into the business. Okay? And there could be possible refund that you're going to get from tax authority by such law. That is, it is possible that you don't have any profits to tax that year, especially when you are a manufacturing or agricultural company, because the policy is that agriculture or manufacturing company are not supposed to pay tax. Sorry, are not supposed to restrict their capital allowance. So they take 100% of their capital allowance. That's what I'm trying to drive at. So in that regard, it's more or less that like cash is being refunded back to you 100%. So that's what we are trying to explain. There are conditions for capital allowance. There are conditions for capital allowance. One of the conditions is that expenditure must be incurred. Expenditure must be incurred. That's one of the conditions for capital allowance. Number two, the person making the claim must be the owner of the assets. If I am the one making the claim, I must own the asset. The asset must belong to me. Okay. Number three is that the asset must be used at the end of the business. When you look at my definition the other time, I said capital allowance, the allowance granted to a taxpayer that has incurred qualifying capital expenditure and put it into production use at the end of the basis period. Now, that means at every point in time, the assets must be in our records at the end of the basis period before you can claim capital allowance. Now, the purpose for which the asset is being used for must be for trade or business. The purpose must be for what? Trade or business. So you cannot say you are using it for private and you want to calculate capital allowance on it. It's not possible. It has to be for the purpose of trade or for the purpose of business before you can claim capital allowance. Where a private portion is, where the asset is used for a private portion, there will be proration. You have to prorate it. Okay. So that is that. The next one is the taxpayer making a claim must apply. Now, where the value of the asset is more than 500,000, the taxpayer must obtain an acceptance certificate for it to be claimed. That is that. What are the common errors that are usually being made by the taxpayer? Insufficient supporting documents. Okay, overclaim. They claim more than what they are supposed to claim, and that affects them with the tax authority. Again, on that claim, if you don't claim the exact amount, let's go to restriction. Capital allowance is restricted, okay, to the number of months in which the asset will be put into production use. It's restricted to the number of months in which the assets will be put to production use. Will be restricted to the number of months in which the assets will be put into production use at the end of the business period. Okay, so again, when we talk about the types of capital allowance, under the initial allowance, capital allowance is never restricted. Okay, because even if the asset is one day, we are going to give it a full allowance. When we get there, we're going to be talking about that. There are still two situations where restriction may arise. Number one, where the asset is used for private purpose and where the base period is less than 12 months. We have talked about this before now. Now, where the taxpayer has incurred expenditure which is allowed to be deducted in computing the capital, in computing the gains or profits for that taxpayer, such expenditure shall be treated as qualifying capital expenditure. Let's say that again. Where the taxpayer has incurred expenditure which is allowed to be deducted in computing the gains or profits of taxpayer. Okay, you have incurred certain expenditure and gains or profits has been included in your computation of your trading profit and loss adjustments. Such will not be treated as qualifying capital expenditure. Do you understand me? For example, I have incurred some repairs on the assets, and probably the person that repaired the asset for you had charged you in excess. You now realize that you had a discussion with that, and the person refunded you. You recognize the profits is more or less like to you, maybe a gain based on your negotiation. So, and that has been included in before arriving at your profits. Then such will not be treated as any expenditure to you. It will not be treated as any expenditure again to you. That's what we are trying to say. Okay. The next one that we need to talk about is when asset is acquired on second-hand basis. Now, we're going to be looking at two scenarios because at this level, examiner expects you to understand this concept I want to explain very well, because questions usually arise from this particular aspect. Questions usually arise from this particular aspect. Okay. Number one, where the asset is acquired on second-hand basis, and that asset that you acquired is building. Where the asset is acquired on second-hand basis, and the asset you acquired is building. Okay. What is the way, or what are the calculations that needs to be done? Now, where a building is acquired on second-hand basis, no initial allowance will be granted. The annual allowance will be granted shall be based on the original cost of the assets and the new purchase price. If I were you, all these things I'm saying, you will jot them down. Now, for building, for example, we have said where building is acquired on second-hand basis, such a building, you are not going to calculate initial allowance on it. However, the annual allowance to be calculated on the building shall be based on the lower of the original cost of the assets and the new purchase price. Okay, do you understand that? So this is what we are trying to say. An asset has been acquired on second-hand basis.
Excuse me, sir.
Yes.
Can you please take that again?
Okay.
The
Yeah, I'll take it again. So where you have acquired building on second-hand basis, we are saying that that building that you have acquired on second-hand basis, okay, will be calculated, the allowance on it will be as follows. Number one, because you had acquired it on second-hand basis, no initial allowance will be granted. You cannot claim initial allowance on the building. Why are we saying that? Because the first owner would have probably claimed allowance on that, right? The annual allowance will now be calculated, will be based on the lower of original cost of the assets and the new purchase price. Lower of the two. Okay? Will be based on lower of the original cost price and the new purchase price. Now, when we're saying original cost, that is the cost at which the first owner had acquired it. Okay? And the cost that you had acquired it from the owner. Okay? We look at the owner of the lower of the two. Now, I know the question you want to ask. I know. I am looking at you. And I'm also reading your minds, everybody. Now, what of if the assets had been bought like 20 years ago, okay? And I just bought it now. The examiner will not test you in that direction, okay? Because if you want to look at that, the original cost would have been so low to the extent that it will be insignificant in your computation. Therefore, that means on that building, if we want to go that direction, we will not get annual allowance. If I have bought building like 20 years ago, that same building that I bought 20 years ago, if I want to buy it now, would have been costing me nothing less than like, if I bought it 25 million then, by now, 20 years ago, especially if it is in a prime area, we are talking of billions now. 20 years ago was when? 2005, right? So imagine you bought your property in Banana Island then for like 70 million. As of 2005, 70 million was a big money. When you look at the cost of buying a house in Banana Island now, it's billions. So even if you had bought it, as at the time you bought it at 70 million, then in Banana Island, go to other areas. Maybe it's going to be like maybe 2 million, 3 million. Even like if it's one of them might not be more than 10 million. Okay. So, but when you compare the price of Lekki Phase 1 now, it's running to like 500 million to buy property there now. So you can see how asset appreciate. So we are not comparing that kind of scenario. An examiner will not test your faith in that kind of scenario. Examiner will give you a price, a cost that is very close to each other for you to be able to make your judgment. Okay. And this kind of question was asked sometimes about 4 years ago, about 4 years ago. They had this type of question where the owner acquired a building, and the building, they tested the lower of these two, they tested the scenario, okay? So examiner could still ask it, okay? And if you have my textbook, when you open Fates Nigeria Limited under capital allowance, you will see it there. Okay, so that is that. We move on. So now note that if the building had not been used before for the purpose of business, okay, then you can claim your initial allowance and annual allowance. The scenario we are painting in this first one is that this building had been used before, okay, for the purpose of trade or business. And if you look at my notes here, it should be noted that the initial allowance can only be claimed on the building acquired on a second-hand basis if it has not been used previously for the purpose of business, or initial allowance has not been claimed on it before. Do you understand? So if initial allowance has not been claimed on the building, or the building had not been used for the purpose of trade or business before, you can actually charge initial allowance and annual allowance the proper way. Do you have any question? Does anybody have any question? Does anybody have any question? In the absence of no question, we'll move on to the other one. Mr. Wellington, are you following us? Okay. Yes, sir. Good. All right. I woke up very tired today. My body, everything was just out. Well, I'm getting better as the lecture is going. But it's okay. We'll do what we need to do. We are committed to ensuring that everything works fine for you guys. Okay. So the next one that we're going to be looking at is other assets. For other assets, the assets in question have not been used for the purpose of generating taxable income, and the assets are acquired on second-hand basis. If that is the case, you can actually claim both initial allowance and annual allowance. I'll say it again. Two conditions must be met. Number one, the assets had not been used for the purpose of generating taxable income. And two, the assets has been acquired through an arm's length transaction. What do we mean by arm's length? According to your property, plant, and equipment, I know PPE, Mr. Wasiu Okwola, that is taking you financial reporting, would have told you that it's a situation where a knowledgeable buyer and knowledgeable seller cannot influence each other because they are aware of the market. They know the price of these things in the market. So I don't have influence on you. You don't have influence on me. We can bargain. Everything that we're going to be doing there will be bargaining. I'll bargain depending on my bargaining power. I could bargain to the extent that will bring down the price, or if I'm not able to, I'll bargain you, the price will go up. So, but at that length, it is considered to be at arm's length because I do not have influence over you, you do not have influence over me. Do you understand? So where the taxpayer cannot influence each other, then we are saying that you can actually calculate your initial allowance and annual allowance for the taxpayer, Jesus Christ. For the taxpayer. Excuse me, guys. Excuse me, guys. Sorry. So having said that, that means at that bargaining, the taxpayer cannot influence each other. So in that situation, even though the asset is acquired on a second-hand basis, the taxpayer can claim both initial allowance and annual allowance. Number two, where the taxpayer are connected, no initial allowance will be granted. The annual allowance will be granted shall be on the unexpired useful life of the assets. So we have said before you can claim capital allowance, the asset must be in use at the end of the basis period. Okay. The next one. Now, there are some assets that will not qualify for qualifying capital expenditure. Let's say, what is qualifying capital expenditure? Qualifying capital expenditure is a capital expenditure incurred for the purpose of earning income or qualifies for granting of capital allowance. By implication, it means that not all fixed assets of the company will qualify for capital allowance. Let's note that. It is not all assets. Because when you are defining fixed assets or we are defining capital expenditure in your public sector accounting, you say it is expenditure that you have incurred on capital projects, right? Or the expenditure, one of the characteristics of capital project is that the useful life is usually more than one. And for fixed asset too, fixed asset is usually more than 1 year, right? Now, let me give you an instance. If you had acquired stapler, Abi, how many of you are still using stapler that you bought 20 years ago in your company? Do you understand me? Stapler could have qualified for that, Abi, because when you look at stapler, for example, stapler has you can use it for more than 2 years. Perforator, you can use it for more than 2 years. Okay? But what do we usually do to all these assets in our companies? Most of us, because of the insignificance of the assets, we expense them. Am I lying? So, Wumi, when you buy stapler in your office, do you capitalize stapler? Wumi, are you responding?
Yes, sir. I said no.
Good.
Expense
Or
item.
anybody here, you capitalize stapler in your company. We are going to expense it, even though we know that the useful life of stapler is more than 1 year. We know, but you will not capitalize it. Abi, that's one. Number two is unlimited useful life of an asset. An asset that has limitless year. Land, for example, has unlimited years to use in life. We all met land here, and we are going to leave land when we leave this world. You can see the power of God. You can see that God is very powerful. Is the omniscience, omnipresence, Alpha and Omega. So land is limitless. So because of the limitless nature of land, we cannot be claiming capital allowance on it. How do you want to quantify the number of useful life of that? You cannot quantify it. Therefore, we say land is not going to be classified as qualifying capital expenditure. Are you following me? Good. So, when you talk about qualifying capital expenditure, these are the categories of assets. Your fixed asset is categorized in such a way that you'll be able to identify if they say furniture was acquired, you will know what to do when you see the definition of furnitures. What are the things that will fall under furniture? When you see plants, what are the things that falls under plants? So, and that is the essence of categorizing all the assets. And for example, building is not limitless. We know that building, according to the arts, the useful life of building, which is the highest in all, is 10 years max, that you can claim capital allowance on it for 10 years. That does not mean that building is going to, you will not have the building again after 10 years. Okay? That does not mean you will not have the building again after 10 years. We are saying that building, for example, building will be, you are going to calculate capital allowance on building for a maximum period of 10 years. So basically, qualifying building expenditure is divided into two. We have the industrial building and non-industrial building. You're going to be looking at all these yourself. You read them. If you have any question, you come back to me. Now, one of the important things that was added in 2019 Finance Act was that any expenditure a taxpayer incurred in the acquisition or development of software or any initial capital outlay on electronic applications will be capitalized. Okay? Will be capitalized and will be treated as qualifying capital expenditure. Do you understand that? So what we're trying to say here is that development of software now is going to be categorized as qualifying capital expenditure. Okay, in the answer of no question, we'll move straight to the types of capital allowance. Types of capital allowance. Mr. Wellington, do you have a question for me?
No, sir.
Okay. Alhaji Hussein, any question for teacher?
No question, sir.
Alhaji, are you in Lagos now?
Yes, sir. I just come back, sir.
Welcome back.
Thank you, sir.
All right. So let's go ahead. So basically, we have two types of capital allowance. We have basically. We also have another capital allowance that arise as a result of disposal. But basically, when we are talking about capital allowance, we'll be talking about two types of capital allowance. We'll be talking about the initial allowance and the annual allowance. Prior to 2023 Finance Act, we used to have what we call investment allowance. There used to be investment allowance. But the 2023 Finance Act took investment allowance out. So there is no longer investment allowance. But you will still be seeing questions that relate to investment allowance if the year is 2023 in your question. Okay? Okay, you'll still be seeing it, which is 10%. Initial allowance is 10%, just like education tax. So your examiner will always give you the rates in the exam. If, for example, we all know that education tax, tertiary education tax was taken out, was replaced with 3% in 2023. Before now, in 2022, it was 2.5. In 2023, they increased it to 3%. Abi? But before that 2.5, it used to be 2%. So that is it. At this our exam, I do not think examiner will assess you to tax on withholding tax regulation. But we are going to talk about the new withholding tax regulation in this our class. I'll share the material with you. We'll talk about it. But I do not think they will ask it. Now, again, the new tax law that they are still fighting on top, the new tax law, the examiner will not test us on it. So even if it becomes effective today, which of course is not likely because they've not even concluded on the new tax law, but even if it becomes effective today, it is not going to be tested in this year exam. So our major focus is still on the old tax law. As in, when I say old tax law, not old tax law. I am referring to the tax law that stopped in 2023 Finance Act. And that is why you have to quickly do this tax and move on. Tax is a dynamic cost because it changes year in, year out. Okay. So what I taught people that did tax about 2 years ago is not what I'm teaching you now. I am teaching you something different. So you have to be very careful and move on with this. Tax does not look like your SFM and all those ones then get constant standard that does not change often. But this one, they change. So you have to move on very fast with it. Okay. So as I was saying, I said we have the initial allowance and the annual allowance. The initial allowance and the annual allowance. For initial allowance, what do we mean by initial allowance? Initial allowance is the allowance granted to the taxpayer once throughout the useful life of the taxpayer. It is granted once. It is granted en bloc. You do not prorate initial allowance. Why? Because it is granted once. That is the act. And one thing that you also need to know is that irrespective of the number of months in which the asset was put into production use, initial allowance is going to be granted in full. Everything, you grant it in full. You don't prorate it. You don't prorate initial allowance. Do you understand me? So, unlike your annual allowance that is usually being paid, you don't prorate initial allowance. So, treatment of initial allowance where qualifying capital is transferred between related parties. Where a capital expenditure is incurred on the purchase of an asset, and either the purchaser is a person over whom the seller has control, or some other person has control over both buyer, both the purchaser and the seller, then the amount of initial allowance will be made in respect of the expenditure shall be the amount as the relevant tax authority may determine to be just and reasonable, having regard to all circumstances relating to the asset and control. That means, in this regard, it is the tax authority that determines what you take when it comes to related party. Okay? So, that is that. We move on. We have discussed the tax characteristics of initial allowance before, one of which I said it is granted only in the first year of use. It is calculated on the agreed cost. It is granted once in the useful life of the asset. It is granted in full, irrespective of the number of months in which the asset will be put into production use. It is taken into consideration in determining of tax now value. Any unabsorbed initial allowance can be carried forward until it's fully absorbed. Okay, and so if you are not able to absorb it, you can carry forward. How do you calculate initial allowance? The examiner will always give you the rates. You do not cram rates to exam. Where you need to cram rates, I will tell you for other topics. But for this one, you do not need to cram rates. Let me show you the rates, the tax table. So this is the tax table. You remember, for those of you that have done skills, that you did tax in skills, or you did tax in your university days, you will notice that they usually give the rates at the back of your question. Especially, except if your lecturer in your school, if you have not done tax in ICAN, especially if your lecturer in your school is very wicked, that's when they will not give you these rates. But they usually give these rates in the exam. So this rate will be given to you. So building, for example, will be 15% initial allowance and 10% annual allowance. Industrial building, 15% and 10%. Qualifying mining expenditure, 95% and nothing. So when you are given any question, what you need to do is to come to this table. It is usually at the back of your question. Usually at the back of your question under examination condition. Just turn to the back of the question and check. Okay. So that is that. Do you have any question for me? Do you have any question for me? Okay. So how do you calculate initial allowance? Initial allowance is calculated on costs. Imagine an asset is acquired and the cost price is 100,000. Let us assume that the asset that was acquired is plants and machinery. Plant and machinery has an initial allowance rate of 50%. So to calculate initial allowance, you just say cost multiply by the initial allowance rate. So what is the cost price? 100K multiplied by initial allowance rate, 50%. So my initial allowance shall be 50,000. Do you understand? That will be 50,000. Okay, that is a straightforward calculation, right? So the next one is annual allowance. Annual allowance. What is annual allowance? Annual allowance is the allowance granted to the taxpayer that has incurred qualifying capital expenditure throughout the useful life of the assets. It is what granted throughout the useful life of the assets. So by implication, we are saying throughout the useful life of the assets, annual allowance shall be granted. Annual allowance shall be granted throughout the useful life of the assets. So if that is the case, what are the characteristics? Number one, that it is granted throughout the useful life of the assets. Number two, it is calculated on a straight line method. We are going to see that as we move on. For annual allowance, it is prorated to the number of months in the basis period. You prorate annual allowance. You prorate annual allowance, unlike your initial allowance that you don't prorate. Annual allowance is usually being prorated. Okay? It is prorated. Number next. If you are not able to absorb the capital allowance, you can carry forward. Number next. It will not be grant claim in full where it is not acquired at arm's length. So you have to acquire it on arm's length. So let's go. How do you calculate your annual allowance? Your annual allowance shall be calculated as the cost price minus initial allowance. Okay? At the cost minus initial allowance divided by the number of years. How do you calculate the number of years? How do you calculate the number of years? The number of years shall be calculated by you saying 100% divided by annual allowance rates. It shall be calculated as 100% divided by annual allowance rates. So if, for example, I have 25% as my annual allowance rates, I'll say 25% is my annual allowance rates. That means the assets we use 4 years. Do you understand? The assets we use 4 years. If the annual allowance rate is 20%, how many years should the assets use? Who is helping us out?
5
Echo, 5 years. Echo, you just entered the class. Welcome. 5 years.
Thank you. Thank you.
5 years. The assets we use 5 years. Do you understand? Oh, I stopped sharing mistakenly. The assets we use 5 years. Okay? So depending on the annual allowance rate, that is also that's also what we're going to use to determine our annual allowance year, as in the number of years the asset we use. So you must know the rates, the annual allowance rate, to know the number of years the asset we use. In my last example that I gave you, I said, assume the asset was acquired at 100K. We had already calculated our initial allowance to be 50K. So I will say costs initial allowance is 50K. So to get my annual allowance rate, initial allowance rate here is 50% for plant and machinery. And annual allowance rate is 25%. That is the rate for plant and machinery. So that means the asset will use how many years? How many years will the asset use?
4
Even
years.
4 years. Thank you. 4 years. The asset will use 4 years. All I will just do is to say Wait. Come on, sir. I need to remove this. Okay. Oh, yes, right? So I will now say 100,000 minus 50,000 divided by 4. That will be what? 12,500. Abi, this will be your annual allowance. 12,500. Subtract. So this will be your what we call tax written down value. So what is tax written down value? Tax written down value is your cost minus initial allowance minus annual allowance. So we now have, what do we have? 37,500. This is year 1. Year 2, because we said annual allowance is constant, we will bring it again in year 2 on a straight line method. So that will be 12,500 minus tax return value of year 1. That will be 25,000. This is tax return value for year 2. Year 3, annual allowance constant, 12,500. Tax return value, 12,500. Annual allowance is constant. But note, however, that in the last year of use, your annual allowance shall be tax return value of the previous year minus 10 naira. I'll say that again. In the last year of use, your annual allowance shall be the tax return value of the previous year, that is this one, minus 10 naira. Therefore, I'm going to have 12,490, giving me my balance of 10 naira. What is this 10 naira? The 10 naira is what we call the residual value. 10 naira is called the residual value. 10 naira is called the scrap value. 10 naira is called the nominal value. Okay, so what we are trying to say here is that at every point in time, when an asset gets to the last year of use, the taxpayer is expected to retain 10 naira. The taxpayer is expected to retain 10 naira. Okay, you can see that it's a straightforward method and it's very easy to understand. Okay, note, however, that this one that we have done here is a situation where the basis period is 12 months. That is a full year. We are going to get equal amount of annual allowance from the beginning to the year to the end if the number of months we have is 12 months all through in our basis period. But where our number of months is less than 12 months, especially in our commencement, when the company just commence operation, the basis period in the first year will most likely not to be up to 12 months. What do you do? In that regard, you must prorate your annual allowance. In that regard, you must do what? Prorate your annual allowance. To prorate your annual allowance is going to be cost minus initial allowance divided by n multiplied by y over 12. What is y? Y is the number of months in the basis period in which the assets will be put to production use. I'll say it again. Y is the number of months in the basis period in which the assets will be put into what? Production use. Do you understand me? Do you have any question?
Okay, sir. Sorry, sir. So for in a year that there is an abnormality, that is when the month is not up to 12, that it was using that the asset was put in productive use. So in that kind of situation now, it can only happen in the first year of the business, not in subsequent years.
Yes, you are correct, sir.
That means the total written down value will also increase.
The tax return value in the first year will increase, right? Yeah. So what we'll do in that scenario is that we would calculate our annual allowance in the first year, prorate it. We will not prorate the annual allowance again. But when we get to the last year of use, the principle that I gave you still applies. Because in the last year of use, the tax return value that you're now going to have here will not be 12.5. Abi? It will now be more than 12.5. But in that last year of use, what you will do is to bring all the capital allowance together and calculate, and just all you just do is to remove 10 naira from this balance. And that will be your annual allowance in the last year of use. You terminate it in that year. I'll explain it again. What I am saying here is that because in the first year, let's assume in the first year, this guy was 6,250. In the last year of use, this will be 18,750. Abi, because this one was abnormal. So what we will do is to terminate this 18,750 in the last year of use by just removing 10 naira from this guy. And that will be our annual allowance here, so that we can have 10 naira in this year. Do you understand me?
Yes, sir.
Good. Okay. That is that. We have explained that. We have explained tax return value. Now, this is what I was explaining the other time. Finance Act 2023 eliminated the investment allowance and rural investment allowance. Before now, a taxpayer that has incurred qualifying capital expenditure in a location that is not less than 20 kilometers from normal facility will be granted rural investment allowance. So, and in such a way, we usually say then that where the taxpayer incur qualifying capital expenditure on electricity, 50% of the qualifying capital expenditure incurred will be granted as allowance, investment allowance to him. Where there is no water and the guy goes ahead to do borehole, 30% of it will be granted to him. Where there is no good tarred road, the taxpayer goes ahead and constructs road, 15% of that will be given to him. Before 2007 tax year, where there is no telephone, 2011, where there is no telephone, the taxpayer will be granted 5% of qualifying capital expenditure incurred to have telephone in his office. But that was expunged from the tax law in 2011, and this total of rural investment allowance and investment allowance was expunged from tax law in 2023. Was expunged from tax law in 2023. So that is why we are not talking so much about that. Other tax incentives, you'll be looking at this yourself. So when Mr. Idris is teaching you tax incentives, he will talk about all this, because examiner could ask you to say something on tax incentives. They are very important. So we'll quickly talk about the next thing that I have in mind today, which is basis period for capital allowance. We're going to do one calculation today and we'll call it the lecture till we meet again next week, Saturday, by the grace of God. When a taxpayer acquires an asset during commencement, the principle is that even if the taxpayer had acquired an asset prior to the date of commencement, the assumption that you give the asset is that the asset has been acquired on the date of commencement. So there could be a situation whereby a taxpayer acquired an asset prior to the date of commencement. The assumption here would be that the taxpayer had acquired the asset on the date of commencement of business. Now, during the commencement of business, just like I've explained to you the other time, there is every possibility that the taxpayer is, the base period for the taxpayer is not up to 12 months. Now, if the base period is not up to 12 months, that means one thing will be affected. One of the capital allowance that we're going to calculate will be affected, which is the annual allowance. The annual allowance will be affected. Why? Because you remember, I had also told you that for annual allowance will be prorated the number of months in which the asset will be put into production using the basis period. So if that is the case, annual allowance will now be what? Adjusted. Okay? Having said this, one thing that you have to also know is that for the purpose of capital allowance, it is not the same way you calculate your depreciation. In depreciation, when you see 1/2/2015, what you would have done is that you would have said, you calculate your depreciation and you will say 11/12 multiplied by the depreciation for that year. Is that not so? To get your depreciation. That's what you will do. And in capital allowance, it is not the same. That is why we have basis period for capital allowance. So the basis period for capital allowance will help us to identify where the assets will be introduced for the first time. It will help us identify where we are going to allocate the assets for the first time. That is the essence of basis period for assets for capital allowance. Unlike your depreciation that takes cognizance of the date of acquisition. We also take cognizance of the date of acquisition, but what we do differently here is that basis period determines the year in which the asset will be introduced for capital allowance of tax purpose. Note, however, that under capital allowance for when we are computing our capital allowance, our basis period will follow the tax principle that we have learned before. Imagine a company that is just commencing operation. You remember I had told you earlier that that company will be assessed with tax from the date of commencement to the end of the first accounting year end. Isn't it? So if an asset is acquired within that basis period, that means whatever happens to that basis period is what you are going to use to calculate your annual allowance. Do you understand? So that is that. So basis period for capital allowance is used to determine the relevant year in which the asset will be introduced for the purpose of calculating your annual allowance and the initial allowance. That is a summary of this, my write-up. Okay. Now, having said that, now that we know the usefulness of basis period, the next thing that we need to do is to look at this illustration. For those of you that have my textbook, all these are there. If you do not have my textbook, or you can request for it, we can also grant you soft copy of the book. And the soft copy is 8,000, while the hard copy is 16,000. Okay, let's go ahead. So, if that is the case, what is our capital allowance? Now, this question was given to us by a business that is just commencing operation. They said the business commenced operation 1/4/2015 and prepares account to 30th June annually. 30th June annually. The following assets are acquired by the company on the date shown below. So they will give you assets and they will show you the date of acquisition. And that is what they have done here. So motor vehicle was acquired on 1st of February 2015. Now, you remember the principle I told you. I said any assets acquired prior to the date of commencement will be deemed to have been acquired on the date of commencement. Abi? Will be deemed to have been acquired. So this asset was acquired on 1/4/2015. Sorry, the company commenced operation 1/4/2015, but the asset was acquired 1/2/2015. So by implication, it means that the assets will be put to production use on what basis? On the date of commencement. Now, because this company is just commencing operation, we are quickly going to write the commencement rule out. So when the company commences operation, we said it's going to be from the date of commencement, 1/4/15 to 30th 6/15. The second tax year will be 1/7, Abi, 16. Oh, yeah, be calling me for me. Oh. To what? I'm waiting for you guys.
30th June 17.
Thank you. Ibukun, 30th June 17. No, 16. It should be 15. Do you understand? The next one will be 1/7, Abi. 1/7 what?
17/16
Mm.
to
To
30th June 17.
17.
good. The next one will be what? 17 to 30 June 18. Now, it is very important to know this basis period. And it is also very important to know when to introduce the asset. Now, this basis period will be used to introduce the assets. So the first asset that was acquired 1/12/2015. We have said any asset acquired prior to the date of commencement will be introduced on the date of commencement. Therefore, motor vehicle will be on this date. Abi, another one was acquired 1/10/2015. Where will it fall? Will it fall within this period? No. Will it fall within this period? Yes. So plants and machinery. The next one is furniture and fitting. Furniture and fitting was acquired 10/8/2016. Where will it fall? Oh yeah. Tell me where it should fall in this our table.
The third year.
The third year.
Good. It will fall within this period. Furniture and fitting. Abi? So that means this year is not relevant for our computation. Except if the examiner now says do for specific year. Do you understand me? So let's look at what the examiner requires us to do here. Now, you know that if this were to be depreciation, it will not be carrying the same way. We are not going to carry it completely the same, but this is capital allowance. So irrespective of the number of when this asset was acquired, provided it falls within the basis period, then the base period, if the base period is 12 months, you are going to calculate full allowance for the assets. So the examiner now says you are required to compute how do you assess a qualifying capital acquired prior to the date of commencement. Who is telling us that? Asset acquired prior to the date of commencement. What is the solution to that?
We'll assume it was purchased on the date of commencement.
Thank you. The next one. The examiner now says prepare asset allocation schedule for 2016 to 2020 year of assessment. What I showed you the other time is the asset allocation schedule. And look at it here. They said for 2016 to 2020, 1 year of assessment. Or to 2020 to 2020. So we could have stopped here. Okay? So that is that. So they now said again, compute the capital allowance for 2016 to 2020 year of assessment. Let's go ahead. So just like I said, the first asset that was acquired will be introduced this date, Abi, in the first year. Now the rate should be given to you. In this one now, I have used the rate for individual. Okay? So, but it does not still affect our computation. So they said the initial allowance rates for individual, because this company, Jessica Venture is an individual. That's why I use that. So 25% of this, we have this, Abi. And to calculate our annual allowance, it should be 20%. It should be how many years now? Annual allowance will be how many years? The answer will be used for how many years?
5
5
years.
years.
Good. Solid student, 5 years. So because when you look at this basis period, it's not up to 12 months. How many months is this? 4, 5, 6, 3 months. So you say 3/12 multiplied by the variance between these two and divided by 5. You will get this. I'll show you here. This is the calculation. That is 1 million minus 2,000, 2.5 divided by 5 multiplied by 3/12. You will get this. So remove that from this guy. you will get this tax now value. Do you understand me? So we bring the annual allowance. You remember that we did not prorate the initial allowance. We only prorated the annual allowance. Why? Because the number of months in the base period is less than 12 months. We move on to the next one. So you bring in this guy to this side. This side, you add the two together to get your total allowance for 2016. We move again to the next one. To get your tax now value here, it is this minus this minus this will give you this. Okay? So we acquire another asset based on this our table in 2017. We will bring that in as new assets. On the new asset that we acquire, we are going to calculate initial allowance on what is the initial allowance rate? 20%. 20% of 1.6 gave us this. Now, because the basis period here is equal to 12 months, we shall not prorate the annual allowance. I'll say it again. Because the basis period is equal to what? 12 months, the annual allowance will not be prorated. Therefore, I'll come here, I will calculate my annual allowance. I will recalculate the motor vehicle that I've calculated before to have this. We are not prorating it. And I also calculate for furniture and fitting to have this. So I go back. No, that was plant and machinery. So for plant and machinery, I have my cost 1.6 million minus 320. What would it give us? It will give us 1,280,000. And the annual allowance rate for plant and machinery for individual is 10%. That means the asset will use 10 years. So I'll divide it by 10 years. I'll get this. Add it together, I'll get this value. We move on. We calculate our tax nominal value again. This, in the third year, we acquire another asset, which is furniture and fitting. For furniture and fitting, the rate is 15%. I'll calculate 15% of my cost. I'll get that. And I'll also calculate my annual allowance. I'll get this. I'll bring it in and I will add it together. The same thing goes for this. This year, 2020, is the last year of use of this asset, motor vehicle. This is year one, year 2, year 3, year 4, year 5. Year 5 is the last year of use. And in the last year of use, I told you the other time, you reduce it by 10 naira. Abi? So in the last year of use, I'll just take my annual allowance is equal to tax now value minus 10 naira to have this value. So in that regard, I will now have a tax now value of 10 naira that will be carrying forward till I dispose the assets. This guy is not last year of use. So I'll remove the initial allowance on this, remove the initial allowance on this. I'll add it together and bring it here. Taxing now value, and I'll also remove my annual allowance to get this. So that is it. That is it. Do you have any questions?
Yes, sir. Thanks so much, sir. I observed
Yes,
that. Is it that for individual, we don't have any investment allowance? I observe we don't have any investment allowance.
Not only because of that. Individual does not have investment allowance ab initio, okay?
Yes.
But I am also saying that the Finance Act had removed investment allowance.
Okay.
So it's no
2020.
longer, yeah.
Okay.
Hello,
Any
sir.
question? Yeah,
I have a question, sir.
go ahead.
Okay, yeah, it's concerning what you just said that the Finance Act has already expunged this investment and rural allowance. But this question we just treated is before 2023. So I don't know, does it mean that that new rule now is applicable to all the questions we see? Or any question that we see that is from 2023? Because that, I think that's where I'm getting it wrong.
Yeah, but it's for 2023. I just did this one straight so that I just want to use this one for explanation.
Okay, doesn't mean we could have actually calculated investment allowance on the plant and machinery for this.
For individual, there is no investment allowance, so we'll not have even calculated it for it.
Okay, yeah, for individual. All right, thank you.
But if it is not that, we can calculate it. Do you understand?
Yes, thank you.
If it is something, we'll calculate it. Any question?
I'm going to chat you up. I need the copy, the soft copy of the material.
Okay, no problem. Okay. So when we meet again, we are going to be talking about disposal of qualifying capital expenditure, where we will talk about when asset is disposed, what is the treatment. Okay, good morning, sir. Where a qualifying capital was purchased at the time during the period. At the time during the period. Does the base period matter in terms of month of? It is the base period that determines where to allocate the assets. And it's also the base period that will, once the base period is 12 months, irrespective of when the asset was acquired, you don't mind. You are just, so imagine a base period that will end on 31st December 2023, and an asset was acquired on that 31st December 2023. That asset will enjoy a full basis period. That's what we are trying. Sorry, we enjoy a full annual allowance, provided it falls within that basis period. Imagine the accounting year end of that company is also 31st December. So if you acquire asset that period, you will calculate annual allowance for that asset. Do you understand? Abiola, you are the one I'm talking to. Okay, good. All right. So when we meet in the next class, we'll be discussing disposal of qualifying capital expenditure. Good day to you.